Carl, you believe this is baloney, that they won't be able to hike. Why not?
Well, the economy is slowing. We saw that most obviously in the GDP number this last week. Retail sales are really quite weak. Wages are dead flat. By all indications, the UK economy is in a slowdown phase right now. I won't call it a downturn yet, but it's a very clear slowdown. Credit growth is slowing. So what's the rationale for hiking rates in an economy where inflation is temporarily above target but headed back to target by this summer, where wages are pretty well behaved, although they are accelerating a little bit? I mean, the only argument that I can see is on the labor market side. The unemployment rate is very low. So as long as the economy is open to immigration, the labor market can't bind and tighten up. So I think that with Brexit ahead, their best course and the course that they'll choose will be, in the face of uncertainty, to do as little harm as possible and wait and see what happens.
Carl, I guess the outlier call that you have would go against the idea that they need tools to deal with the downturn or something ugly happens with Brexit. So do you not think they need a little bit of a toolbox, and the only way to replenish that toolbox is by hiking?
Well, they had their opportunity to do that, and they had the perfect pretext to do that last year when retail sales were still growing at 6–7% in volume terms, when the economy was unambiguously strong, even though there was no inflation around. That was the time to rebuild the so-called room to maneuver, but not now, not when things are slowing, and not when we're only 399 days today away from Brexit. This isn't the right time to be squeezing the economy.
Let's go all Neil Ferguson right now. Let's do a counterfactual on the United Kingdom. Michael Darda, what would Jude Wanniski say? What would Jude Wanniski say about this odd political economics that's known as the United Kingdom? Well, how do you get a supply side pop there?
Well, I don't think you're going to get a supply side pop, at least in the foreseeable future. He'd probably characterize Brexit as a sort of supply side shock. If you make the movement of goods, services, capital, people more difficult, then that will tend to reduce efficiency. That lowers productivity. So if you're lowering productive potential over time, you also have a less favorable trade-off between nominal and real GDP.
The backup of this, of the